Here is a number worth sitting with: $60 billion. That is roughly what SoftBank has now committed to OpenAI and its surrounding AI infrastructure, more money than the market value of Ford or Colgate or Kellanova. And here is the detail that makes it strange. SoftBank does not control OpenAI. It cannot vote out the board, it cannot force a sale, and OpenAI is not publicly traded. So SoftBank cannot simply sell its stake on a bad afternoon the way it could dump shares of Amazon or Nvidia. Most of that $60 billion was borrowed, not earned. And this week, for the first time, the company has to explain that bet out loud, on the record, at its quarterly earnings briefing this Thursday, August 6th. Today we trace exactly how a Japanese holding company ended up this exposed to a single American startup, and why the market has already started pricing in the possibility that it goes badly. Back in the spring, SoftBank led a funding round that valued OpenAI at $850 billion. Since then, reports have surfaced that OpenAI is now targeting a $1 trillion valuation for a future IPO. Skeptical analysts, running OpenAI's revenue against normal software multiples instead of AI boom multiples, put a fair value closer to $300 billion, less than a third of the headline number. That gap between what SoftBank is paying and what a sober accountant might write down is not a rounding error. It is the entire bet. SoftBank is not buying OpenAI at a discount. It is buying it at a price that only makes sense if OpenAI's revenue grows roughly as fast as the most optimistic AI forecasts on Earth. And every dollar of that bet that was borrowed rather than earned makes the bet less forgiving if growth merely slows down instead of stopping. SoftBank did not write a $60 billion check from its own balance sheet. It borrowed. A $40 billion bridge loan, running to March of 2027, was raised specifically to fund a $30 billion follow-on investment into OpenAI. On top of that, SoftBank took out a $20 billion margin loan secured against its shares in Arm, the chip design company it already owns and controls. Layer that together and you get the actual shape of the deal. SoftBank pledged a company it built and controls, Arm, as collateral to raise cash for a company it does not control, OpenAI. If Arm's stock price falls, that margin loan gets more expensive or triggers a cash call at the exact moment SoftBank also needs cash to make its next OpenAI payment. Two separate bets, quietly wired into the same pressure point. Here's the detail almost nobody covering this story leads with. SoftBank reportedly explored borrowing directly against its OpenAI stake itself, using the position as its own collateral. Lenders said no. A private company's valuation, set by a handful of funding rounds a year and unverifiable by public markets, is not collateral a bank wants to hold if the borrower can't repay. So SoftBank had to pledge something real instead. Arm, a publicly traded company with a market-tested price every single day. That single rejected loan application tells you more than any analyst note. The institutions closest to the deal, the ones with money actually at risk, do not trust OpenAI's $850 billion sticker price enough to lend against it directly. They will only lend against something the market can price in real time. The financial term doing the most work here is loan-to-value, or LTV, which is just the size of your debt divided by the value of what's backing it. SoftBank's own internal target keeps that ratio under 25% in normal times, and the company says it was sitting around 17% as of the end of March. Credit rating agency S&P Global, running its own math, put the real number closer to 33%, nearly double SoftBank's preferred ceiling, before revising it down toward 20 to 25% after Arm's share price climbed. Why does that gap matter? Because Arm's stock is the one lever in this entire structure SoftBank does not fully control. A stretch of bad chip sector news, a slowdown in AI hardware demand, anything that knocks Arm's price down mechanically pushes that ratio higher, tightening the loan's terms right when SoftBank has the least room to absorb it. This is not a hypothetical stress test. SoftBank has roughly $30 billion in concrete obligations due in the second half of 2026. A fixed calendar, not a forecast. Inside that number sits a near-term tranche of about $22.5 billion still owed to OpenAI by year-end, plus servicing on the bridge loan and the ARM-backed margin loan simultaneously. Compare that $30 billion bill to what SoftBank is actually earning. Its Q1 net profit for this fiscal year is projected at roughly 148 billion yen, call it $941 million. That is not a company that can casually write a $30 billion check out of quarterly earnings. It is a company that has to keep refinancing, keep selling assets, or keep finding new lenders willing to extend credit on a schedule it does not fully control, against a stake it cannot easily sell. Markets tend to know things before the earnings call confirms them, and this one has been talking for weeks. SoftBank's share price has fallen nearly 50% since early June, cutting the company's market value roughly in half in about 2 months. At the same time, the cost of credit default swaps tied to SoftBank, essentially insurance that pays out if the company defaults on its debt, has been climbing. Rising insurance costs on a company's own debt is one of the more honest signals in finance because it's institutions putting real money on the possibility of trouble, not pundits offering opinions. And yet, as of this month, 15 of 20 sell-side analysts still rate SoftBank a buy. That split, a collapsing stock and rising default insurance on one side, a majority bullish analyst community on the other, is exactly the kind of disagreement that makes Thursday's earnings call worth watching. If this shape feels familiar, it should. Masayoshi Son built SoftBank's entire modern identity on exactly this move. Borrow big, buy a stake nobody else will take at that size, and defend the price with total conviction. The Vision Fund's most infamous version of that bet was WeWork, a company SoftBank valued at $47 billion before its IPO collapsed, and the real number turned out to be a small fraction of that. We covered exactly how that one came apart in this channel's Collapse series, and it's worth naming the pattern honestly. Son has also been right at this scale before. ARM itself is one of his conviction bets that worked. The OpenAI position is the same playbook at a bigger number, with debt doing more of the lifting than it did with ARM, on a company growing faster than almost anything SoftBank has ever backed. Masayoshi Son has heard every version of this argument already, and his answer has been consistent and blunt. He has called questions about whether AI is a bubble foolish and absurd, and has said publicly that meeting global AI demand will require roughly $5 trillion a year in investment by 2040. If you take that number seriously, SoftBank's $60 billion position is not a reckless outlier. It's a rounding error on where the entire industry is headed. And being early and leveraged is exactly how Son made ARM, and the best of the Vision Fund's early bets pay off. If you don't take that number seriously, the same $60 billion looks like a highly leveraged wager on a valuation that 3 different sources can't even agree is $300 billion, $850 billion, or $1 trillion. Thursday's earnings call is where Son has to make that case to people holding his debt, not just his fans. Zoom out past SoftBank specifically, and this fits a shape we've flagged before on this channel. AI's financing is increasingly circular. We've covered how NVIDIA has offered to help guarantee financing for the very customers buying its chips, and how hyperscalers are collectively committing something like $660 to $690 billion this year alone, much of it debt-financed, to build capacity for demand that is still, in large part, a forecast. SoftBank borrowing against a chip company to fund a stake in an AI lab is one more link in that same chain. Money moving between a small number of interconnected players, each one's balance sheet leaning partly on the next one's growth actually showing up. None of that makes the bet wrong. It does mean that when one link gets stress-tested, in this case SoftBank's on Thursday, the whole chain is worth watching. So what should you actually watch for out of Thursday's earnings briefing? Not whether SoftBank posts a profit, it almost certainly will. Watch whether Son offers a specific, credible plan for the $30 billion in second-half obligations beyond "we'll figure it out." Whether the loan-to-value ratio has crept toward S&P's higher estimate or stayed near SoftBank's own target. and whether there's any update on that stalled effort to borrow directly against the OpenAI stake itself. None of those answers will resolve the underlying question whether OpenAI is worth $300 billion or $1 trillion is not something one earnings call settles. But it will tell us whether SoftBank is managing this bet from a position of strength or scrambling to keep plates spinning on a debt load that's already showing up in its stock price and its insurance costs. SoftBank's $60 billion bet on OpenAI is either the boldest correct call of Masayoshi Son's career or the most expensive lesson in what happens when conviction outruns the balance sheet backing it. And right now, the stock price and the credit markets are voting for the second answer more loudly than the analysts are. What makes this story worth tracking isn't really SoftBank. It's that the same debt-fueled, circularly financed pattern sits underneath a meaningful chunk of the entire AI build-out, and SoftBank is simply the first name on the calendar to have to answer for it in public this Thursday. To be clear, this is education, not financial advice, so weigh the risks yourself and talk to a licensed professional about your own situation. Tomorrow on Collapse, Enron, the original financial illusion, and why the tricks that sank it are still worth knowing in the AI era. Subscribe so you don't miss it.